the faster something goes up, the brighter that bug zapper light glows, and the more people it lures in. And it at some point, once this tide turns, once this spike kind of ends, there will be max like exodus, and it'll be like people scared and they just dump shares. But I think one of the things you kind of touched on is, say you get in and it goes up 150% or whatever, and you're like, well, I'm just going to hold on to it. I think that is the mindset of a lot of people because they're like, I'm up so much, I can let it pull back, I can let it do its thing before potentially going higher because they've got a lot of buffer. They're up so much. Generally, though, when it starts to fall, they start to panic and they're like, I'm giving so much back, and they usually get out.
Markets move in cycles, and few patterns are as predictable as investor behavior during euphoric rallies. When prices surge rapidly, emotions often override logic. The faster an asset rises, the stronger the urge to join in. That's when greed blinds discipline, creating a bug zapper effect where investors are drawn to the light of quick profits, only to get burned when the trend inevitably reverses. It's a powerful reminder that market tops are built on excitement, not fundamentals. The real challenge isn't buying early, it's knowing when to take profits, avoid FOMO, and preserve capital for the next opportunity. Technical strategist Chris Vermeulen, founder of the Technical Traders, emphasizes the importance of efficiency and timing. His focus isn't on chasing every move, but on managing capital through trend analysis, getting in early, exiting before the decline, and letting money compound in stronger assets while others go dormant. He warns that gold, silver, and miners may still have room to run, but buying at emotional highs can be dangerous. Discipline ultimately prevails over excitement in the long run. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This volatility, whether it's straight up or straight down, lures more people in because a straight up move just creates FOMO. And there's all kinds of studies that show it's more painful for an investor to watch something go higher without them and think that everybody else is making money but them than it is for them to take a loss. So the faster something goes up, the brighter that bug zapper light glows, and the more people it lures in. And it at some point, once this tide turns, once this spike kind of ends, there will be max like exodus, and it'll be like people scared and they just dump shares. But I think one of the things you kind of touched on is, say you get in and it goes up 150% or whatever, and you're like, well, I'm just going to hold on to it. I think that is the mindset of a lot of people because they're like, I'm up so much, I can let it pull back, I can let it do its thing before potentially going higher because they've got a lot of buffer. They're up so much. Generally, though, when it starts to fall, they start to panic and they're like, I'm giving so much back, and they usually get out. The same scenario kind of happened leading in 2007. If you follow technicals, it would have gotten you out. It would have allowed you to repurchase later and then play another one of these moves to the upside. And this would be the same mindset as what you just touched is you're in this beautiful trade. I think I'll just hold it. And yes, if you hold it long enough, the buy and hold strategy does usually prevail. But here's the thing, you pretty much, wasted 13 years of no returns where you could have put that money somewhere else. Imagine making 13 years worth of returns for 13 years compounding. And so this is what I want to avoid. My whole strategy is I want to avoid the sell-off. I don't mind selling a little bit lower wherever the trend changes. And I don't want to waste 13 years. I want to put that money somewhere that earns money. And gold doesn't really pay you, right? If anything, it costs you money. Whether it's an ETF, there's a management fee, or if you store physical gold, you've got an annual fee. So instead of holding on to it because you like it and you're like, I'll just hold until it goes higher because it naturally will. What if you had 13 years? You could put it in something else that goes up 5 or 10 or 14% every year until then, and then you just get back into gold when it actually says that. And so that's what I focus on. I focus on, it's not about making as much as you can on every move. It's about knowing when to get into a trend, when to hold it, and when to get out, and then to move that money to another asset that can work while this other asset is dormant and not doing anything. So I work on efficiency. I don't want to waste time, and I want to be constantly pulling money out. And that's the strategy I do. And it's not rocket science. It's not super exciting, but it allows us to navigate these markets, and we don't have 13 years of no returns. When we go back and we look at the 2000 and let me just see if I can get this chart back here. If we go back and look at when the stock market peaked in 2007, it was just as gold and everything took off, we saw about a 2-month rally, about a 2-month move in the precious metal space and the stock market that pushed up to all-time highs. And the stock market topped out, but the mining space and some of these other risky plays continued to move higher. So just based on the last push is telling me I think the stock market actually could top out before that. I think precious metals still have 6-8 weeks to the upside. And as you can see here, as the stock market starts to go down, this is when we see precious metals have that big push. So I think we're about to see one more big push, because right now we are equivalent to like right here for gold, meaning the stock market is about to pull back and gold, silver miners, and Bitcoin are probably about to shoot higher. Bitcoin's the wild card. I don't know if it's going to move with the NASDAQ or not. As you know, it has a pretty close relationship with the NASDAQ. So I'd scratch out Bitcoin because it has a lower probability, but we're on target for about a 1 to 2 month rally in metals still. 2 more big green bars based on what happened in the past. I mean, it's just a rough guesstimate. Buying right now is chasing. I think what somebody would need to do would be to, like, this is the GDX, for example, but it's the same for gold and everything else. We need to see some type of quick reset and consolidation, some little pause here. So it regains, it builds some bullish chart pattern. It could be a pennant, it could be a bull flag, whatever that pattern is. And then when it starts to break and starts to run higher, then I think you kind of look for the breakout of that pattern or the breakout to a new high, because this type of price action actually will restabilize it and give it kind of the next thrust to the upside. But right now we're seeing what is a running correction in the mining space, which is instead of doing like what it did back here, it rallies up and then it puts in a nice bull flag. That is very strong, consistent. This move here to the upside is what the next measured move should be to the upside. And now we're getting into it's having this running correction, meaning it's gapping up and down all over the place. It's correcting and shaking the hell out of people on the way up. It's not actually pulling back and pausing. And this type of price action is volatile. At any point it could just shoot higher and you're like, I missed it. It could spike up to 100, or it's going to have a very sharp correction and reset a little bit and maybe build a bull flag pattern. So I would not get in here. I think you've missed that move. Now you need to like let it consolidate, take a pause, and then potentially get in on the next run. Because right now you're literally you're walking through a landmine. This is going to be a big green bar or a big red bar over the next week or two. I think we just have to see how this settles. And I would rather miss out on upside than buy it here and then it crashes and I'm like, I paid the high. Why did I do that? So I don't get FOMO like everyone else does. I don't mind missing out. I always know there's another trade. I mean, we're long the precious metal space already, so I definitely don't need to get in here. But waiting, you can't just buy because you feel like if you feel like you're missing out, you're probably paying a premium. You got to wait for a pause or pullback.
The current price action in gold and silver is undeniably thrilling. Charts are going vertical, momentum is explosive, and the emotional wave is unmistakable. Yet beneath the excitement lies a critical lesson that history teaches again and again. Parabolic moves rarely last. When every trading day opens higher and enthusiasm dominates, it's often a sign that the cycle is maturing, not beginning. In past rallies, this pattern has repeated rapid acceleration, followed by months or even years of sideways consolidation. Many investors who waited a decade for the move end up entering at the very top, driven by emotion rather than analysis. Technical discipline offers a different lens. Instead of chasing headlines or reacting to sentiment, it focuses solely on the price's behavior. Those who followed the charts were positioned early when gold broke out of its multi-year base, when silver started forming higher lows, when miners began outperforming. Now, as the move extends and retail participation spikes, the setup demands caution, not euphoria. Late entries carry asymmetric risk. A single reversal candle can erase weeks of gains. Managing risk, trailing stops, and respecting the cycle are the keys to survival in these moments. Let's get back to the interview.
there's a lot of price action going on. It's pretty exciting. I mean, we're in. If you look at the chart that I have, I'm kind of showing from the lows to the highs back in the 70s to 80s based on percentage moves from those levels, and you can see we're actually, actually not too close to the same percentages. We still have quite a ways to potentially go. But when you look at the price action, the curves on the chart, usually when things start to really go parabolic and start to go straight up, like the last few bars, those are usually the ones you need to be aware of. When it feels so easy and every day just opens higher and higher, no matter what, that's usually a bit of a red sign. And I think, if we look at GDX, the miners, this is a really good example. Just look at the last three bars. It's just popped and gone parabolic. And same with silver miners, pretty much every miner, in fact, they're going straight up. And this is as exciting as it is. The crappy part is people get into like the precious metal space and they hold on to trades for like a decade or so, and it doesn't do anything. And then suddenly, like 3 months, the rally happens, and this is where a lot of people get caught. Is they've waited so long and it goes up so fast. It feels great, it looks great, your account recovers, but people think, well, I'm going to ride this. This is just the beginning. But keep in mind, you go look at these rallies, they're all like 4 or 5 months long and then they're dead.
That's right.
This is the thing. So many people, buy metals or get into stocks and things on fundamental data. They're like, oh, the economic situation is good. The fundamentals are good. But it might take forever to get to this price. Whereas if you follow technical analysis got us into gold and silver in 2019 when this well, it got us into gold in 2019. And that was when that whole cycle, the next super cycle in gold started. And that's the nice thing about technical analysis is when you follow technical analysis, gold peaked out in 2011, and then it went into a multi-year stage one base, and then it broke out. Technicals usually get you in before the economic data. So over here it says get into gold. It's starting a new upward cycle, and then finally, the fundamental, the economic climate, the whole fiat like monetary policy is now like it couldn't be any more in favor for gold. And I know people have always said, well, gold's always been in favor for like the monetary policy to change and fiat currencies, but if you just follow technicals, it will get you in when the actual trend is flowing and in the right direction. And then usually the fundamentals and all that stuff will fall on your lap. You're like, oh, okay, well, now we're in the sweet spot where not only price is up, but now the actual economic environment matches it. And when you put those two together, you get these parabolic moves, the perfect storm. But a lot of people don't get in until the perfect storm hits like they are right now. And that's why we're seeing this feeding frenzy. It's like, you really technically should have been in the start of the new bull market back in 2019 for gold, or at least got in, in 2024 when it broke out of that multi-year pause, right around, 2100 over here. That's the technicals get you in early. And then if the trend matures and the fundamentals fall on your lap in favor, that's when you get these giant parabolic moves. There's so much turmoil in countries right now. People don't trust the systems, the government, like there's so much going on. It's just the perfect time for gold. And that's why it's taking off. And it has people also thinking, this is going to be, a lot of people think this is it. Gold's going to go to the moon, 5,000, 10,000, 20,000, these, crazy values. And maybe it will, but, the shorter term, when you look at just the normal cycles, we're in that late stage. And everything is fun and exciting right now, but it's very short-lived. These rallies are short-lived. They last a few months when it's really exciting, and then they can go dormant for 4 or 5 years again, and that's what we need to be aware of.
And then it stays flat for 15 years. And
yeah, but it holds a lot more value. Like the metals hold up. Well,
Yeah.
At least gold holds up better, where miners can crash back down. So this is the problem. People have been in the mining space for 10 years or so waiting for this. And then it happens in 3 months, and they think it's just getting started. But there's a lot of signs here saying that actually this run could actually be coming to an end, and we might go into a big pause. Maybe it won't sell off huge, but maybe it'll trade sideways for 6, 8 months, or maybe it'll pull back 20, 30, 40% if the market does go into a recession, just like it did back in pretty much every other pullback in the market. So people just need to be aware that, just because it's starting to rally and it's happened so fast, doesn't mean it's not going to last for years. You generally aren't going to see the prices run up when you see this type of price action. It's kind of like a little tulip bubble here.
I have a lot of friends. Well, I have one friend in particular who isn't, a professional investor.
And this is like, I mean, I'm in this space. I communicate with thousands of investors, especially in the precious metal space every week, and you can cut the air with a knife. If you don't hold physical metals or you're not in miners, you feel left behind. And that is it. People are literally just going to Costco and buying metals. They're probably, going to the Canada Post, the post office here sells metals. I mean, they're sold out. I'm surprised I haven't heard an ad on TV. We buy your used jewelry, because that's what happened at the last peak. But this peak has happened so fast, I think, or this rally, the ads and the people promoting gold haven't caught up yet, because it's only like, really 2 months in. So I think we're very close to seeing price continue to rally here, but we're about to probably start seeing it headline news like absolutely everywhere about, buy gold on your credit card and sell your jewelry and all that stuff. And that's going to be a real red flag, because that's usually the last people piling in and all that. Well, generally it still comes down to price. You still need price to reverse. And usually that requires, in this type of price action, unfortunately, it requires a huge red bar. It usually requires either a huge gap higher on an opening of a bar and a huge sell-off, or it requires price to run way up and then close way down at the lower end of the candle, showing that it got bought up, but then sellers slammed it and sold it off. So we need some type of reversal candle. And to me, it'll be on this type of chart that we're looking at now, which is the monthly chart. So this is the problem. A lot of people always want to buy at the lows, pick a bottom, and then they also want to sell at the top. The reality is, if you manage positions and risk, you're never going to get in at the bottom, and you're definitely not going to get out of the top unless you very luckily happen to pick it. And you can't really pick turning points. You can do okay, but it's not very accurate. And if you look at that silver reversal, you got to give back a huge chunk. So I still believe we're going to see a big spike in silver and gold, like in another month here. When things start to really shoot higher, if this next green bar, the bar we're in right now, shoots up dramatically, if for silver we get up like over 52 or 55 or 58 or something, there's going to be a point where it's like, okay, I'm going to start putting a very tight trailing stop. So as price just keeps stretching higher, the stop naturally just chases it higher with the brokerage. So when it does start to reverse, it just kicks you out. That's kind of the only way you can try to maximize profits when you get into this phase, but you're never going to get out at the top unless it's just a lucky guess. So you just have to accept that this is nice, but eventually you're going to give some of it back if you're going to get out to lock in gains, because it's just the way it is. Yeah. You don't want to, just exit for no reason. It could just keep going higher. I have a feeling in this market environment, because it's still, I feel a little early in the feeding frenzy where people are just piling in. People are now numb to gold hitting all-time highs. It's been doing it forever, it feels like. But silver, I think, is going to spark a hell of a move. I think it's such a tiny market too, that I think it could really explode, as I mentioned, like up into the 80s. So I do think it's going to spark a big wave of buying. If we look at just drop down to the 10-minute chart. So there are signs that there's some big money investors starting to move out. So this is the 10-minute chart of gold from last week. Twice throughout the week, we saw a big high volume sell-off in gold. We saw that twice. So we're getting up into that nosebleed territory, that there are some big players starting to cut back their allocations in gold. We saw this in silver as well. But all that's doing is just telling us that a lot of people think it's a good price to start locking in some gains. But I do think we're going to see silver, probably percentage-wise, it looks primed and ready to really have, as I mentioned before, a very strong green bar that could just be absolutely ludicrous. And it will suck in the rest of the people who aren't in. And unfortunately, they're probably going to pay a high, and they're not going to see it reach those highs again for many, many years after that. Silver has a great way of putting some pretty explosive moves in and then having epic reversals to the downside.
As the rally in precious metals intensifies, the real challenge isn't spotting the opportunity, it's managing it wisely. The euphoria we're witnessing in gold and silver often signals the later stages of a significant move. History shows that when markets surge vertically and sentiment becomes universally bullish, the cycle is usually nearing exhaustion. Yet, this phase also reveals who understands discipline and who's driven by emotion. Those positioned early, based on technical signals, are now reaping the rewards, while late entrants risk becoming liquidity for the smart money exiting. This is the phase where strategy must overrule excitement, tightening stops, booking partial profits, and staying alert for reversals. Every bull run eventually pauses, and the next fortune is made by those who preserve capital for the next wave. The metals story is far from over, it's simply evolving. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.